But, you know, at the core of this, and the debate we were having on the show as well, is basically crude oil prices, right? Above $100 a barrel right now, with the war impacting the world's oil stores. The Strait of Hormuz, which is the space from where all oil flows, is right now choked up. Which are the sectors that look like they're going to be impacted? What's the math as far as India is concerned? Soumya Sarkar joining in with more.
Well, if you look at Brent crude prices, they have surged nearly more than 65% right now in the last 7 trading session. Currently trading around the $119 per barrel mark as against 70.7 that that we had seen a couple of days back. Now it is trading at the highest level since the Russia-Ukraine war had started, and on a YTD basis, crude prices have gained more than 80%, which is the best start to the year that we have seen for crude oil prices, at least since 1997. Now, what will be the impact on the economy, given the fact that 85% of our crude requirement is imported? A $10 per barrel rise in the crude oil prices widens our current account deficit by anywhere between 0.4 to 0.5% of the GDP. When it comes to the inflation, it increases the CPI number by around 30 to 50 basis points and WPI number by around 80 basis points. Now, this completely depends on how much of this is passed on to consumers. And when it comes to GDP, the growth can come down by at least 15 basis points as per analysts, but that will again depend on how much of this is passed on to the consumers. Now, when it comes to the companies and sectors, oil marketing companies like IOCL, BPCL and HPCL, a rise in crude oil prices will impact the marketing margins. With increasing crude oil prices, the marketing margin goes down. Earlier it was at negative 20%. Right now, with this increasing crude oil prices will further fall for the oil marketing companies, and every 0.5 rupees per litre change in the marketing margin lowers the EBITDA of IOCL, BPCL and HPCL by anywhere between 7 to 11%. Now, apart from that, if you look at other sectors like aviation, paints, for both of them, 40% of the raw material cost is either fuel or crude derivative, and with increasing crude oil prices, their margins is also expected to get impacted. For lubricant manufacturers like Gulf Oil and Castrol, nearly 50% of the raw material is either crude or crude derivative, and their margins will also get impacted if this is not passed on to consumers. For tire companies, synthetic rubber, carbon black and various other chemicals, all prices of all these things are derivatives of crude, and with rising crude prices, the prices of these raw material will also increase. For cement companies, nearly 40 to 50% of the raw material basket is either directly or indirectly related to crude, and this will also impact their margins. For a host of specialty chemicals, it is negative because crude derivatives are part of the raw material, and they could also get impacted. On the positive side, but this is positive as long as the government does not impose windfall tax. Now, for ONGC, Oil India, Vedanta and HOEC, higher crude oil prices means higher realization, and higher realization means higher earnings. With every $5 per barrel rise in Brent crude prices, ONGC and Oil India's EPS increases by anywhere between 7 to 12%. But again, this completely depends on till the time the government doesn't impose any windfall tax.
Very, very important. Thanks so much, Soumya, for lining all of that up for us. So it's far beyond just the oil marketing companies. So therefore, downstream and upstream oil companies,